Are your investments secured from the risks of inflation? What are your ways to hedge your portfolios? Inflation is one of the many things that people in business and investors are afraid of. If it does not happen today, it will eventually happen in the coming days or in the future. Remember that 10 years from now, a dollar won't buy the same amount of products. Inflation is to blame for this. Inflation refers to price increases over a predetermined period of time. It gauges the average price level of a basket of goods and services in an economy. A certain quantity of money will have decreased purchasing power due to inflation. Finding the appropriate tactics and investments to protect against inflation is crucial. To learn more, watch this video as we give you a few ways to hedge your portfolio against inflation. Inflation is a normal part of an economy, and inflation hedging can be used to prevent declining buying power by offsetting the predicted decline in the price of a currency. Hedging against inflation can also aid in preserving an investment's value. Even though certain assets could offer a respectable return, if inflation is taken into account, they may be sold at a loss. By developing asset classes that outperform the market throughout inflationary environments, a disciplined investor may prepare for inflation. You can protect your portfolio against inflation in 6 different ways. Number 1. Reallocate money into stocks. As inflation starts to rise again, the bond market often takes a hit, while the stock market may benefit. To benefit from this potential trend, think about shifting 10% of your portfolio from bonds to equities. A 60/40 stock/bond portfolio is a simple investment plan that will help you protect against inflation. But keep in mind that due to the impact of compound interest, it will underperform over the long term compared to an all-equity portfolio. Compared to a portfolio that contains a higher proportion of equities, you might find that you are missing out on returns. The option of purchasing preferred shares is another one. These liquid securities may depreciate in value less than bonds do when inflation occurs, while paying a greater yield than the majority of bond kinds. Utility stocks are a third option. They have a price that fluctuates somewhat predictably over the course of the economy and also pays consistent dividends. Number 2. Consider real estate. Real estate investing has a lot of benefits. This asset type offers stable income through dividends and has inherent value. Because of the constant need for housing, regardless of the state of the economy, and the fact that as inflation increases, so do property values and rental rates, it frequently serves as an excellent inflation hedge. Yet, real estate is illiquid because it is a tangible asset. Real estate investment trusts, REITs, which are more liquid investments that can be bought and sold easily in the markets, are an alternative to take into account. Companies that hold and manage portfolios of industrial, residential, and commercial buildings are known as REITs. They frequently offer better returns than bonds and generate income through leases and rents. Another major benefit is that because of their relatively stable operational costs, their prices are likely to be less impacted when interest rates start to climb. Number 3. Look to TIPS and invest. The impact of inflation on your portfolio can be reduced by selecting investments with built-in hedges. Treasury inflation-protected securities, also known as TIPS, are a particular class of government bonds created to aid investors in weathering the ups and downs of inflation over time. The primary of TIPS investments is based on fluctuations in the Inflation Measuring Consumer Price Index, CPI. TIPS principal rises in response to inflation, rises in the CPI, and falls in response to deflation, declines in the CPI. TIPS base its interest payments on the principal's adjusted value and do it twice annually. Treasury inflation-protected securities, or TIPS, are intended to appreciate in value over time in order to keep up with inflation. They are regarded as one of the safest investments in the world, since the U.S. federal government backs them. The bond's principal amount is reset in accordance with changes in the Consumer Price Index, which is the index to which they are connected. TIPS applies the adjusted principal to a set rate of interest that is paid twice a year. TIPS are available in 3 maturities: 5, 10, and 30 years. There are some hazards associated with TIPS. If you sell your investment before it reaches maturity, you can lose some money because they are sensitive to any change in the existing interest rates. As government-backed bonds, TIPS are among the safest ways to invest against inflation. So, the danger of losing money is lower than with other investments, regardless of how inflation changes. Number 4. Diversify with the right stocks. If you buy in the proper firms and make a move in line with your investing goals, using stocks as a hedge against inflation can be a successful strategy. For instance, it would be wise to invest in businesses that can raise their prices at a rate that is consistent with inflation, like the ones in the consumer staples sector. This could help them maintain a steady flow of earnings, which could be advantageous to your portfolio if the business distributes dividends to shareholders. Furthermore, take into account how inflation fits into the broader context of the economic cycle. Selecting defensive stocks could be a wise move. For example, if rising prices are forcing you to cut back on non-essential purchases. Defensive stocks are those that represent consumer staples like food, energy, and household goods that they always spend money on. Defensive stocks may benefit in the early stages of a recession, since people may prioritize purchasing basics. Some investors may switch their investments to cyclical equities that represent businesses that offer discretionary goods and services, like hotels and restaurants, which typically outperform in robust economies as a recession eases and inflation follows. Some investors can explore foreign and emerging markets in addition to domestic stocks. Investing abroad in companies that are performing well could help balance off lagging returns when inflation is contained to one economic ecosystem, by the United States. Number 5. Consider precious metals. Gold and other natural resources have traditionally been employed as effective inflationary hedges. Compared to other types of investments, gold has a tendency to keep its value, or even increase in value, during times of increased inflation. You don't need to purchase gold bricks or jewelry in order to invest in gold. Via an exchange-traded fund or ETF, one can easily access investments in gold or other precious metals. As gold ETFs trade on an exchange much like stocks do, they can provide the advantages of gold investing in a highly liquid package. Using an online broker like Ally Invest, you can invest in gold ETFs. Number 6. Seek for assets that are inflation hedged. Current events affect how much inflation is there in an economy. The escalating cost of raw commodities like oil and rising salaries are two reasons that cause inflation. As a result, as economic indicators raise concerns about stagflation or rising inflation and stalled growth, individual investors and portfolio managers are boosting their holdings of commodities, shares, and index-linked gilts. Yes, these are wise moves, but it's also critical to look for assets that are hedged against inflation. Regardless of inflation, you must first consider where to invest, how safe it is, and whether it will prosper even if the economy weakens. So, look at your investment mix as a whole and assess where you stand to keep ahead of inflation. There are no quick fixes. To offer a prospective return that can keep up with the effects of growing prices, you may need to combine investments. When inflation strikes, keeping inflation-hedged asset classes on your watch list can help your portfolio thrive. It would be best if you then acted when you noticed inflation starting to take shape in an actual, organically growing economy. We all hope that inflation won't ever cross our economy, but of course, we don't want to encounter it unprepared. So before getting to your plans, if you have any, consider these 7 ways to hedge inflation to keep your portfolios protected. No one wants to put their investments at risk, so if you are still starting to invest, look for the ones that would still keep your money no matter what the seasons are. We hope you have learned something from today's topic. What do you think about this topic? Do you agree with me too? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe. I'll see you in the next video.